Welcome, guys, to a wonderful journey of understanding the world of banking. As our informative videos converge with your interests and sincere efforts, you will surely become an expert at banking.
In our earlier video, we had a glimpse of the basic functions of banking. We will do a quick recap of what we learned before we proceed on today's topic on overview of banking products. As per the Banking Regulation Act 1949 of RBI, a banker is a person who undertakes the business of banking. The basic function of banking includes accepting deposits from the public for the purpose of lending, repayable on demand or otherwise, withdrawable by check, draft, order, or otherwise. The vertical that accepts deposits is termed liabilities, while the vertical that lends money is known as assets. Both depositors and borrowers are customers for the bank. Banks classify their products into liabilities and assets. Let us dive deep into understanding this better. As discussed earlier, banks classify their products into liabilities and assets. Let us look at liabilities first. Liabilities is the vertical that accepts deposits from the customers. Liabilities are in fact the bread and butter for the banks. If they do not have sufficient deposits, they will not have money to lend and make profits for their investors. Liabilities are categorized as demand deposits and term deposits. As the name suggests, a demand deposit is one that the customer can demand back from the bank at any time. A client can demand his deposit back even at midnight through any channels like RTGS, NFT, IMPS, UPI, ATM withdrawal, check transfer or clearing, demand draft, online funds transfer, bill pay, or through a setup mandate of electronic clearing system. Banks must promptly make payments based on the specific transaction type's turnaround time. A term deposit is a product where the client and the bank agree to a specified tenure, rate of interest, principal amount, maturity date, maturity amount, and maturity instruction. The term deposit receipt or passbook specifies these details and is an agreement between the bank and the customer. Premature withdrawal of these products will attract penalties on interest as per the policy of the bank. Demand and term deposits differ in features, interest rates, payment methods, and contractual terms. The products of demand deposits include savings and current accounts. The products of term deposits include fixed and recurring deposit accounts. Let us understand the purpose of savings and current accounts. The savings account, as the name suggests, is a product provided to customers to accumulate their savings from various sources of income. The current account, on the other hand, is a product provided to customers who engage in various businesses for processing their day-to-day business transactions. Let us understand the basics of term deposit products. In fixed deposits, the client deposits the investment amount in lump sum, whereas in recurring deposits, the client deposits the investment amount in lesser amounts over period at regular frequencies. Recurring deposits have standing instructions set up in savings accounts to debit the monthly contributions. Let us dig deep and understand the basic principles of asset vertical. Asset vertical products are categorized by collateral backing and customer profile or business turnover. Loans or advances extended to customers are categorized on the basis of whether the loan or advance is backed by collaterals. A loan supported by collateral or security is known as a secured loan. The value of the loan is technically derived from the value of the collateral, although the client needs to have the income capacity to repay the loan, be backed up by the credibility of his or her financial or repayment track record, and invest a part of his own funds in the form of capital infusion. The client's income is reduced by their financial commitments and current loan obligations. An unsecured loan is a loan that does not require collateral. The value of an unsecured loan is derived from the income capacity of the borrower to repay the loan, the credibility of his or her financials or repayment track record, and his current financial obligations. Let us look at some type of secured loans that banks offer to their customers. Some of the frequently extended loans are home loans for buying, improving, or renovating homes, car loans for buying used or new cars, two-wheeler loans for buying used or new bikes, super bikes or scooters, and commercial vehicle loans for buying new or used commercial vehicles. Banks also extend loans for buying used or new construction equipment, finance advances against existing property owned by clients, extend advances on income earned from lease rentals, and provide loans against securities like equity shares, debt and equity mutual funds, bonds, debentures, national savings certificates, etc. Let us look at some type of unsecured loans that banks offer. Some of the frequently extended unsecured loans are personal loans for medical emergencies, travel, marriage, down payment of property purchase, and other uses. Unsecured business loans for business purposes. Unsecured loans extended to self-employed professionals like chartered accountants, doctors, architects, etc., and education loans of smaller values. Loans are also classified based on the turnover of the customer as retail and corporate or wholesale. Retail segment loans would comprise loans of smaller ticket size with higher volumes and distributed risks. Corporate or wholesale segment loans would comprise loans of large ticket size, lesser volumes, and higher risks.
I hope you enjoyed our video on overview of banking products. We will be back with more informative videos. Do collaborate with our channel in our endeavors to spread the expertise on banking by liking, subscribing, and sharing our videos. Subscribe to our channel by clicking the bell button. Turn on the notification button to keep yourself notified of our new videos. Share our channel with your peers to provide value to others with similar interests.